Thank you for tuning into the Buyer's Guide podcast, where we talk all things property and finance. My name is Peter Mastriani, the founder of the Buyer's Guide, and in today's cast, I outline the five main investment strategies that Australians use to build wealth. Seems straightforward enough, so let's get to it. Wealthy individuals in Australia broadly will fit into one of three categories. Firstly, you're born into it or inherit it perhaps. Secondly, you could earn a very high income and do so through some form of business or entrepreneurial type activity. Or thirdly, you just make really good financial decisions and you do so throughout your lifetime. Now, of those three options, one is in stark contrast to the others. In fact, you can be an average wage earner and make smart investment decisions and secure your financial future. Now, these smart investment decisions can be numerous, as within our banking, superannuation, investment, and taxation systems, a number of methods do actually exist for people to use to improve their financial positions. Now, if you are considering using property as a wealth creation vehicle, as you should be, five commonly implemented strategies are used by modern day Australians. Now, these consist of the first strategy, and a popular one, and certainly worthy of mention considering the recent attention that it's getting in our political environment, is negative gearing. So, negative gearing is certainly a favoured option compared to shares, and the reason behind that is because of the ability to gear up or leverage at higher ratios without having to actually sell the investment should the market turn south, as long as the repayments are met, obviously. Now, negative gearing doesn't always mean that you actually have to suffer a real income loss. Because of tax add backs, like depreciation, it is possible to achieve all the tax deductions associated with negative gearing, but with a positive cash flow. Now, for many investors, their high yielding investments will start paying them from day one. Even though borrowings can be at 100% or near enough to 100% of the actual purchase price, the taxman, mainly helps them achieve this. Now, the tax benefits can be quite significant, making the real cash flow or making the real cash flow positive for investors, even with more moderate incomes. Now, some important facts that you do need to consider is, one, the hiring gearing ratios are achieved with property as opposed to shares. Secondly, higher salaries can equate to higher deductions. Thirdly, ownership and lending structures can have a significant effect on your tax consequences. It's very important to remember that one. And if you do use net yield figures to assess affordability, um, on new properties, when you actually crunch the numbers, they do tend to result in higher net returns, and that's due to larger depreciation amounts. Now, tax variations on your personal income can also improve the cash flow, and it's all about growth. Growth is where the wealth is made. Now, as I touched upon, we're leading up to a new election, a new federal election, and negative gearing is definitely going to be a political hot potato. Now, over the weekend, just gone, the federal government announced that they won't actually be making any changes to negative gearing in the upcoming budget. Naturally, this was met with the familiar cries that the tax concessions distort property prices and encourages speculative investing. Now, a lot of vocal criticism came from various commentators, one of which released a white paper titled Hot Property, Negative Gearing and Capital Gains Tax. Awesome title. Now, in a break from tradition, the Prime Minister responded to the criticism through his blog, mind you, and noted that the white paper, in effect, was, to quote, littered with factual inaccurate statements, claims that were unsupported by evidence and direct contradictions, and its economic analysis in many places leaves a lot to be desired. He further builds the case for negative gearing by noting the effects of its removal on the rental market and income equality, the former of which has been advocated by a number of individuals, including myself, mind you. Now, from my point of view, I think that it seems increasingly probable that Liberal, or Labor governments for that matter, will probably maintain negative gearing in its current form. If they don't, it's going to be really interesting to watch what actually unfolds. The simple economics of demand and supply should make the stable market of property a little rocky, at least for a little while. Now I should make a mental note of this because it probably is going to make a great future podcast episode. But anyway, we should move on. The second strategy that I would like to talk about is superannuation. And why is it that Australians love their superannuation? The reason behind it is because it's probably the closest thing that we have to an offshore tax haven within our own domestic tax environment. There are significant tax advantages available through your superannuation, and we all love to pay less tax. The minimum tax you pay on the way into the fund is 15% of your gross income, not your net income. And that's compared to the highest rate of 49%, which you would pay on the same earnings if you were in the highest marginal tax rate. Now, if you do have a self-managed superannuation fund, you can control the timing of this tax and reduce it further with negative gearing, or by claiming expenses like personal insurance premiums, meaning that 15% can even be reduced further. Now, capital gains tax payable under superannuation will be at 15% instead of 49% when sold within the first 12 months of acquisition. After 12 months, the capital gains tax rate reduces to a maximum of 24.5% outside of super and only 10% within super. If you sell the asset after retirement, you don't pay anything. Now, self-managed superannuation funds do give you greater control, but look, they do require a lot of additional responsibility. A lot of time, there's a lot of administrative tasks that are also associated, and those factors mean that it can be quite costly to actually establish and to run. Now, it was around about 2007 or so that the laws actually changed, which allowed negative gearing into property using a self-managed superannuation fund. Since then, property has been the fastest growing asset class inside of super. So if you are considering going down this route, look, I strongly advise you to get good professional advice for the establishment and the ongoing management of these funds. Penalties for non-compliance can be really expensive, which does make a small, management fee or the associated management fee, really well worth it. Also, if you are doing anything naughty or considering doing something naughty within your self-managed superannuation fund, I would strongly advise you not to, because look, it is an area that the government is closely watching, and if you do something naughty and you get caught out, the penalties are severe. So some key points to summarize superannuation. Firstly, remember, you can't actually access your super until retirement. You need to realize that it's going to be for the long term. The big advantage of this is a beautiful little thing called compounding. So over the lifetime of your contributions and the growth of those compounding numbers, look, those sums should be pretty significant, which will only benefit you in retirement, as 90 odd % of individuals that retire actually retire on less than $42,000 a year. The age pension, if you're a single, is around about $16,000 a year. So the more you can add into super over the long term, the better off you're going to be in retirement. Now, another key point around superannuation is obviously, like we discussed, there's healthy tax savings, and they can definitely be achieved through your superannuation. And having a self managed superannuation fund is certainly advantageous because of the element of control. It also allows you to purchase property through gearing, and there are some pretty nice estate planning benefits as well. But we can touch upon that in a future podcast episode. Now, the third strategy that I will talk about is debt recycling. Now, in previous podcasts, we have discussed good debts and bad debts, and we've just discussed that in a bit of detail. And the way to make this situation as efficient as possible is through debt recycling. So debt recycling is really just a method of structuring your investments in a way that transfers your bad debt into good debt as efficiently as possible. Now, most people are paid directly into their savings account, followed by moving that income into their home loan and their credit cards and personal loan, and have a little bit of money left over for living expenses, and if you're lucky, contribute to a holiday fund, and if you're really lucky, have an emergency savings fund on the side as well. Now, money in your savings account will pay an interest rate of less than 1%. If it's a high interest savings account or a term deposit, at the moment you could probably get less than 3% at best. Now, you may have a home mortgage, for example, and hypothetically, let's say that mortgage is worth $300,000 and the interest rate that's associated is 5%. Now, it's important to note because when you borrow money from the bank, i.e., for your home loan, it's at 5%. And when they borrow money from you, meaning the money that you actually have in your savings account, they're paying you less than 1%. So, to structure this into your favour, you do so through debt recycling. And the first thing that you need to do is establish a 100% offset facility through your home loan, or start using it if you haven't already done so. Now, a line of credit facility can also be used. They are very similar to an offset account. Through my personal experience, though, for some reason people do find offset accounts a lot easier to manage. However, the next step is that you need to get all your income paid directly into that offset account. The money will now offset the balance owing on your home loan, therefore reducing the interest that would actually be payable. Meaning for each dollar you have in your offset account, you're actually saving yourself interest at 5%. Also, you're not paying the tax on the interest earnings as well. So theoretically, it's even higher than 5%. Now, once you've done that, the focus can shift to part two of the strategy. So in this scenario, we have a mortgage of $300,000 on a property that's valued, let's say, at $550,000. Now, most lenders will lend up to 80% of the property value without actually incurring lender's mortgage insurance. So 80% of $550,000 is $440,000. So if you owe $300,000, that means that you essentially have $140,000 of equity available for you to use. Now, you could hold $40,000 in the offset account as a buffer, as your rainy day fund, and split the remaining $100,000 into a separate lending facility. You then use that $100,000 to purchase your next investment property. Once that money is spent, it now becomes tax deductible, and the rental income received is paid into the 100% offset facility, reducing the non-deductible debt faster. Once more equity is built up, you just rinse and repeat the scenario. Now, over time, this will save you thousands in interest. It'll cut years off your mortgage, and at the same time, you're going to be building a nice investment nest egg on the side. Now, some key points to take away from this is that you do need to use a 100% offset account to reduce the non-deductible debt. You need to repay non-deductible debt before deductible debt, i.e., pay bad debt before good debt. You need to use the equity that you have available to invest in income-producing assets, and you also need to pay all your income and surplus funds into the offset account and leave it there for as long as possible. And you need to structure your home loan with your future investments in mind. Now, strategy number 4, it's all about modern investment fundamentals. Okay, so there are many, but a few things hold true no matter how modern the times. And these are the 4 key aspects that I would like to concentrate on. Firstly, investors with time and patience on their side, with the discipline to actually stay the course, are always well rewarded in the long run. The second thing is diversification and risk management strategies that align to your risk profile will help you sleep much better at night. Thirdly, yield and growth are equally as important. Yield should cover your costs as best as possible, and then capital growth should be the concern, or a better description, that the capital growth is really the cream on top. Fourthly, don't speculate. And the age-old saying applies. If it does sound too good to be true, it's pretty likely that, it is. Now, the last strategy, or strategy number 5, that I will touch upon quickly is risk management. Now, I won't cover this in too much detail, because I will explore this in later detail in a future podcast episode. However, risk is everywhere. We do risky things every day, and we don't think anything of it. Almost all of us will drive on a daily basis. It's probably the most dangerous thing that we actually do. A white line is really the only thing that separates us from a potential accident. However, we have all built up expertise, some more expertise than others, to prevent incidents. Our vehicles are better protected, and in turn, we protect those vehicles ourselves. So by this rationale, I guess what I'm trying to imply is that you need to apply the same risk management strategies to your property investments, or any investments for that matter. You need to build up your own expertise, and you need to mitigate expensive capital outlays, should an incident occur. So, look, there's 3 key things, I think, around risk management. The first of which is that insurance is really the foundation of any solid wealth creation plan. And insurance premium should certainly be viewed as an investment cost, or a cost of doing business. Secondly, insurance premiums can be paid through your superannuation fund. And thirdly, insurance can be used effectively for estate planning purposes as well, which is really important. Now, these are the 5 most common strategies that people will deploy to build wealth through property investment. And look, there's different strategies that are applicable within each of those 5 broad overarching strategies. I think what's important for you to know is that investment strategy, it's very specific to the actual investor. Therefore, it's really impossible to actually compare outcomes for different individuals, because in most cases, property is going to be a long-term investment. That is, unless you actually possess some particular expertise, or you develop knowledge within renovation and flipping property, or property development for that matter. So, to really achieve the property investment sweet spot, there are two specific agendas that you will really need to concentrate on. The first of which is the financial aspect. So, the questions to ask around this is, how much to spend, in terms of your capital outlay, including your costs, how much to borrow, and how best to hold the assets to actually maximize the income and the tax effectiveness. So, the asset holding structures, I guess. Now, each of these can only be given justice when individual circumstances are really assessed. As it's going to be different in every scenario against the backdrop of your own needs, circumstances, wants, and desires. Now, the second aspect that you do need to consider is both yield and growth. Now, many factors can influence the yield and the long term capital growth a property can achieve: location, demographics, comparable sales, infrastructure, employment prospects, the actual physical dwelling itself will all influence those factors, or the factors around yield and growth. However, long term growth is far more efficient in producing wealth than yield. Astute investors focus on growth. The problem, though, in doing so, is that you really need to satisfy the cash flow requirements. And if you are on a low to medium income, and if you can't sustain periods of vacancy or outward expenditure or interest rate rises, then it's probably more relevant for you to pursue an income strategy. I have to stress you really need to satisfy the cash flow objectives, or else you can find yourself into a position where you could actually be struggling to make ends meet, which will just mean that you're trapped into your job, a job that you may not even like, but you need to be there and maintain that position because you've essentially invested yourself into a corner. Um, Even a worst case scenario is that you actually have to sell before you actually recoup your costs and make any type of significant profit. Conversely, though, high income earners could wear some of the expenses and claim the tax depreciation. Therefore, even though growth may produce a better result over a 20-year period, perhaps it would be better for some to really pursue a strong yielding property to help satisfy the commitments of the growth properties in their portfolios. Ideally, I believe you need to have a combination of both growth and high yielding properties, and structure it in the most efficient way possible. Um, that way, you can move income between negative and positively geared property to satisfy the cash flow and the taxation requirements. Now, modern investment fundamentals will always ring true, and there are plenty of opportunities available within each of those five strategies that I've outlined. So, if you would like to discuss these strategies in more detail, particularly for their relevance to your own individual circumstances, please do feel free to get in contact with me via www.thebuyersguide.com.au, and be sure to subscribe so you don't miss out on any future podcast episodes. That's all for today. So be sure to subscribe, check out the Buyer's Guide website, and until next time, bye bye.